Hi everyone, I'm Michael Ruger. I'm the managing partner of Greenbush Financial Group, and today we're going to be going over making cash gifts to family members. It's a common occurrence that parents want to make cash gifts to their kids or grandkids, and the main question is, does someone have to pay tax on it? Do you have to pay tax when you make the gift? Do they have to pay tax when they receive the gift? So we're going to go over those pieces because it really is impacted by the annual gifting limits. We're going to touch on those, your lifetime gifting limits, which will also impact whether or not someone has to pay tax on it. Do you have to file special tax forms in the years that you make those gifts to a family member? We'll cover some advanced gifting strategies too, because some parents do want to make large gifts for children to purchase a house or to start a business. There's ways that we can work around those annual gifting limits by putting some advanced strategies in place. And also, you have to be aware of the cost basis pitfall when you gift non-cash assets to people, because they can be tricky and there could be big tax liabilities waiting for those people receiving the gift if you're not aware of how they work. Let's start off by going over the annual gifting exclusion amount, which for 2021 is up to $15,000. So I can give any number of individuals up to $15,000 per year. I won't owe any gift tax. They won't owe any gift tax. It's really a non-taxable event. And that amount does not count towards my lifetime exclusion, which we're going to talk about in a little bit. But if we have a child and I'm married, actually me and my wife can both give $15,000 to that child. So technically we can gift $30,000 per year to each child without going over that amount. Now, people incorrectly assume that if I gift over $15,000 per year, that's when the gift tax comes into play. For most people, that's not correct. You can gift over that amount and not typically pay gift tax on it because of the lifetime exclusion, which we're going to talk about next. The federal government has something called a lifetime estate and gifting exclusion, which means as long as I don't give away over a certain threshold or my heirs inherit over a certain threshold, no one owes any federal tax on those amounts. So from a gifting standpoint, in 2020, I would have to give away as an individual over $11.5 million before anyone would owe any gift tax. If I'm married, it's actually $23.6 million before anyone would pay any gift tax on those gifts to kids, family members, or anyone else. In an example, you could give $10 million to one of your kids tomorrow and they wouldn't owe any gift tax. You wouldn't owe any gift tax because it's below that 11.5 lifetime threshold. So the question then becomes, well then what's the point of having this $15,000 per year gifting limit? That $15,000 threshold is really the amount that doesn't count against your lifetime exclusion. So if I give, let's say, $15,000 per year to 10 different people, so that's $150,000. That $150,000 would not count against my 11.5 lifetime because I kept it below that threshold based on those individual gifts. It's only when you gift over that $15,000 annual amount that those amounts start to eat away at my lifetime exclusion. Since these lifetime limits are so high, most people realize they're not going to be gifting away $1 million during their lifetime, or their heirs aren't going to be inheriting millions of dollars. So this gift tax issue really becomes a non-issue for a lot of people. But if you ever gift someone over $15,000 per year, you will have to file a gift tax return with your taxes. Even though there's no taxes due, it acknowledges that gift over and above the annual exclusion amount, and that's how the IRS tracks how much you've eaten in to that lifetime exclusion that's available to you. Up until this point, we've really talked about the federal limits, but you also have to be aware of your state limits, which can vary from the federal rules. Like we're in New York State, so individuals in New York have a state exemption of $5.8 million over their lifetime, which is still a big amount, but it's lower than the federal 8.5. So if you were to give someone $8 million, you'd be free and clear on the federal side, but you could owe some state tax. So it's really important to know how your state handles gifts in addition to the federal limits. It is important to acknowledge that these limits can change over time. They're not set in stone. So even though the federal limit is at 11.5 today, does not mean the federal government may not drop that down to, let's say, $1 million a few years from now, because it's no surprise to anyone that with the federal deficits, the state deficits that have been going up and up, at some point they're going to need more tax revenue. And one way to do that is by lowering these limits. So when people pass away or gift, it generates more tax revenue for these government entities. So you don't want to be wasteful with your gifting strategy, because those exclusions keep those amounts from counting against that lifetime amount, and you might need more lifetime amount if those limits are lowered at some point in the future. There are advanced gifting strategies that can be used to help preserve your lifetime benefit and use more of your annual exclusions if you want to give larger amounts in a single year by actually using promissory notes. So the way this would work is if I had a daughter and she started a business and I wanted to give her $200,000 to get it up and running, I don't want to necessarily gift her the $200,000 because I'll use a big piece of my lifetime exclusion that I might need in the future. Instead, I can issue her a loan for the $200,000. We actually drop a promissory note. It's an official loan between me and her, but we make the payments and the duration of the loan such that each annual loan payment might be conveniently $15,000 per year. So what I do is I give her the $200,000 in the form of the loan, and then essentially each year I gift her the $15,000 that she's just using to repay the loan to me. And then within my will, I would say if I pass away before the loan has been paid in full, the loan is forgiven. So that's just one of those advanced strategies that can be used. What I want to cover is the cost basis trap associated with gifting non-cash assets to individuals. So this would be if I'm gifting a house, a car, I'm gifting stock. Like, it's important to understand that when you gift these assets, the gift amount is the amount of whatever it's worth at the time you gift it, but that person inherits my cost basis. And the best way I can explain this is if I have a stock that I purchased, let's say 10 years ago for $50,000, and now it's worth $300,000. If I want to gift that stock to my daughter, that gift is a $300,000 gift, what it's worth today, but she inherits my $50,000 cost basis, which means if she turns around and sells it tomorrow, she's going to have to pay the gain, the $250,000 gain that's appreciated, versus if I just held on to that stock and I pass away and then my daughter inherits it, she may receive a step up in basis upon my death under the current tax rules, which says her cost basis is now $300,000. She sells it for $300,000. There's no tax due. So the difference of paying no tax versus paying a gain on $250,000, just be aware of that inheriting the cost basis from the previous owner rule that exists, because it could impact whether you decide to gift it or whether you decide to let someone inherit whatever that asset happens to be. There is another advanced tax strategy that lies within that example that I just gave you. So if you have appreciated securities that you're holding and you would like to make a gift to a non-for-profit, a charity, a college, sometimes people will take those appreciated securities and actually gift them outright to those non-for-profits, because if they sell them, they're a non-for-profit, they don't pay any tax on the gain, and then sometimes you can capture that large deduction based on a good portion of the fair market value depending on your AGI. Again, this is a very advanced strategy, so you really want to consult your tax professional, but it's something that's out there that you may be able to use. I hope this was helpful. If you have any questions, of course, please feel free to reach out to us at moneysmartboard.com. Thank you.